Welcome back to the Stocks Update. BigBear.ai just dropped its latest earnings, and while the headline shows a smaller loss, the real story is far more complex. Is the company on the path to growth, or headed deeper into trouble? Let's break it down. In the latest financial quarter, BigBear.ai disclosed a net loss of $62 million, which at first glance might appear as a major improvement when compared to the $127.8 million net loss recorded during the same period a year ago. However, this seemingly positive comparison can be misleading unless we examine the financials more closely. This video is for informational and educational purposes only. It is not financial or investment advice. If you decide to invest, please do your own research. Your money, your decision. Let's revisit the previous year's numbers. That $127.8 million loss was inflated by a one-time accounting charge, a goodwill impairment of $85 million. This charge does not reflect regular business operations, but rather a necessary adjustment due to a past overestimation of an asset's value. If we exclude this non-recurring expense, the actual operational loss for that quarter in 2024 was about $42.8 million. When compared to the most recent $62 million loss, it becomes evident that BigBear.ai's bottom line has actually deteriorated, not improved. To truly understand the impact of this, it's essential to grasp what goodwill impairments are and how they affect financial statements. When a company acquires another business, the purchase price often exceeds the value of the tangible assets. For instance, if the acquired company's physical and financial assets are valued at $100 million, but the purchasing company pays $600 million, the additional $500 million is recorded as goodwill on the balance sheet. This goodwill represents intangible elements like brand value, customer relationships, and anticipated synergies. Over time, if it's determined that the acquired company isn't worth what was initially believed, perhaps it underperforms, or market conditions change, the acquiring company must acknowledge this by reducing the value of the goodwill. That's what happened with BigBear.ai in Q1 of 2024. They acknowledged that they had overvalued a prior acquisition and wrote down $85 million from their books. Since this was not repeated in 2025, comparing the net losses year over year without considering this adjustment paints a distorted picture. Now, moving from the net loss to a more operational metric, adjusted EBITDA, which essentially measures a company's core profitability before accounting for non-cash items, interest, taxes, and other irregular expenses. BigBear.ai reported a negative $7 million adjusted EBITDA for Q1 2025. That's a noticeable decline from the negative $1.6 million adjusted EBITDA from Q1 2024. Once again, things have not improved, they've worsened. The primary reason for this worsening performance, according to the company, is a delay in government contract funding. BigBear.ai had hired staff and allocated resources based on the assumption that certain government projects would move forward. However, those contracts were either paused or delayed, leaving the company with excess capacity, employees, and infrastructure ready for work that didn't materialize. As a result, the company had to bear the cost of these idle resources, which contributed to its deeper losses this quarter. What's even more concerning for BigBear.ai is the broader political and economic environment. The U.S. government is currently in a cost-cutting phase, largely influenced by political figures like former President Donald Trump and allies such as Elon Musk, who are working together to identify inefficiencies in government spending. Though Elon Musk isn't part of the government, he's playing an influential role in shaping budgetary discussions, especially with a focus on reducing unnecessary expenditures. One of the outcomes of these efforts is a push for sweeping spending cuts, as part of a broader legislative package to extend Trump-era tax cuts. The early drafts of this legislation reveal plans to offset those tax cuts with hundreds of billions of dollars in reduced spending across various sectors, including healthcare, food assistance, and government technology services. For a company like BigBear.ai, which heavily relies on federal contracts for a significant chunk of its revenue, this trend poses a substantial risk. The company could see a continued slowdown in government-related projects, which would further hamper its financial recovery. Despite these challenges, there are a few silver linings. One is the company's growing backlog, which represents future contracted work. BigBear.ai's backlog grew to $385 million by the end of Q1 2025, a 30% increase compared to Q1 2024. This backlog is critical as it indicates secured revenue that should be recognized in the coming quarters. In other words, even though revenue generation may be slow right now due to delays, the company has signed agreements in place that should eventually translate into future income. Another point of optimism is the company's improved cash position. At the end of the most recent quarter, BigBear.ai reported having $108 million in cash reserves. This is a significant increase from the $81 million it held at the same time last year, and even more impressive compared to the $50 million in cash it had at the end of 2024. However, it's worth noting that this cash wasn't generated from the company's day-to-day business operations. Instead, it came from external financing, essentially investors injecting more money into the company to keep it afloat. This means BigBear.ai is still very much reliant on investor confidence and will likely need to continue raising funds until it becomes consistently profitable. Looking ahead, the financial outlook for BigBear.ai shows a company in transition. Projections suggest that the company will continue to experience negative free cash flow for the next couple of years. In 2025, it's expected to burn through approximately $30 million in free cash. That figure is forecasted to improve in 2026, but it will still be negative around $10 million. The good news is that by 2027, Wall Street analysts believe the company could break even, finally reaching a point where it is neither losing nor gaining cash from its operations. Beyond that, things start to look more promising. Analysts project that by 2028, BigBear.ai could generate $80 million in free cash flow, and that number might climb substantially to $300 million by 2029. If those forecasts materialize, the company would be on a strong trajectory of sustained financial growth, potentially becoming a major player in the AI-driven analytics and government services sector. From an investment perspective, this long-term potential must be weighed against the current risks. Based on a discounted cash flow analysis and future growth assumptions, a fair valuation for BigBear.ai's stock would be around $3.13. At the moment, however, the stock is trading at $3.87, suggesting that the market has already priced in some of the expected future growth. That said, for those who believe in the company's long-term prospects and perhaps see it as a potential next Palantir with similar government-focused analytics capabilities, it may still represent a compelling speculative opportunity. In summary, BigBear.ai's financial story is one of short-term challenges but long-term potential. While current performance metrics indicate increasing losses and cash burn, there are signs of stabilization on the horizon. The growing backlog and improving cash reserves offer hope, but the company must navigate a turbulent political environment and prove that it can convert future opportunities into real, sustainable profits. If you found this video helpful, please give it a thumbs up and consider subscribing to the channel. Your support helps us continue to bring you in-depth market analysis. Thanks for watching, and I'll see you in the next video. Take care.